Yup. We're back. I know you guys missed us last week because we missed you.
Last week?
We were on last week? Oh,
yeah, 2 weeks ago.
I don't know.
We were on last week.
Somehow it's October. I have no idea what's going on.
It's week 4.
I know. I have no idea what's going on. All right, yo, shout out to all the gangsters in the live chat. We love you guys. Thank you so much for coming. Everyone's here on time. Dave Wilson, Midwest Cannabis. Cliff is here. Sean's here. Random Trends in the house. Who's buying the dip? Somebody. Nick Kaspersky, what up? Jay Luther. Hamager. CEO.
I bought the dip today.
Old Testament's in the house.
I'll
Having some
reveal it
drinks.
later.
Feeling that. All right. Hey, everybody. Welcome to an all-new edition of What Are Your Thoughts? My name is Downtown Josh Brown, here with my co-host, Michael. Say hello to the people.
Hello.
Hey, I have an announcement to make. We are bringing the show, The Compound and Friends, to Charlotte, North Carolina, a live event. It's going to be let's say late afternoon, early evening in Charlotte.
Will there be barbecue?
Hell yeah, there will. Location TBD, but it's Tuesday, November 7th, and we are going to give you guys a chance to be the first to hear about the details. All proceeds of the event will be going to No Kid Hungry, which is our favorite charity, and it's really exciting to be down south and doing this live for our friends in the North Carolina area. So if you want to get the details before everyone else, the thing that you want to do is send an email to askthecompoundshow@gmail.com, and we will blast that information out to our list first before we put it anywhere else about how you can get a ticket, and it's going to be one hell of a night. I can promise you that. All right, we have a sponsor tonight, Mike?
We sure do. Rocket Money.
Okay.
Rocket Money is a personal finance app that finds and cancels your unwanted subscriptions, monitors your spending, and helps you lower your bills all in one place. I think I might have told you this, or might have told the audience this. I discovered that I was already paying another company that was like the same type of subscription, 5-year subscriptions. I swear to God.
That's so meta.
But I also discovered, so I get emails when there's like large transactions. I'm like, hey, wait a minute. Didn't I just get billed for this?
Yeah.
The guy that I work out with, I was being charged every 20th of the month, and all of a sudden there's like 3 charges in the last week and a half. I'm like, hey, buddy, I got the cops watching you.
Who's the guy that you work out with, Ben?
I hate working out. I absolutely hate it. I pay a guy to watch me work out so that I actually do it. I hate it.
It's hysterical. So that you show up? Does he come to your house or you go to his gym?
No, neither. Zoom.
Oh, for serious?
For serious.
Okay. So
anyway, I saw
Rocket Money.
I got multiple emails for, like in the weekend. I'm like, oh, what's going on, buddy? And he blamed the software. I'm letting it get slide for now. I'm working out with him on Friday, and we'll see. I'm gonna judge his reaction face to face or Zoom to Zoom if it really was the software, if he was trying to pull one over.
Okay.
I'll give him the benefit of the doubt. He's a good guy.
One more time on the call to action.
Rocketmoney.com/compound. It will save you money, save you hassle.
Give
it's all
it a
good.
shot.
I love it.
What do you have to lose? Worst case scenario, you find some stuff you're paying for no reason, and come on.
Because you know what? I'm not
in this economy.
I'm not a line item guy with my credit card. I see the bill, it comes in, goes out. Yeah, this looks about right.
Yeah.
But all right. Before we get the show started with the topics, I just want to give a public service announcement. Today was an ugly day. Try it on, please, John. Today was an ugly day on Wall Street.
Wait, are you jumping in front of my?
I am.
All right,
I'm cutting the line. I'm cutting the line. Just right across the board. I think it was a 90% down day, which means 90% of the issues, not just the S&P, but that trade on the New York Stock Exchange, were down. It was pretty ugly. Chart off.
USA Czar is saying, I joined that, quote, I pay a guy to watch me. What did I miss?
I hate working out. If I don't pay for somebody to hold me accountable, I won't do it. I hate it.
How much are you paying this guy? I'll watch you. How much are we talking? I'll get the nugget to watch you.
So, okay. Seasonally, this is lining up. The old Sel Roche Bayom.
Yeah.
What? What else you got to say, wise guy?
Put that shit show back up. I want to see this thing.
Yeah, it's ugly.
I've been in transit all day. What went up today? Like a little bit of health, like a little bit of pharmaceutical.
Yeah, really nothing.
Mondelez had a good day.
I took this at 3:15, so it's probably even worse by the close. But seasonally, this has lined up. I know we joke sometimes about seasonality, but the end of September, for whatever reason, the whole sell Roche biome, I don't know why it works, but it tends to work. And then next chart, please. We get a 5% pullback more than 3 times a year on average.
This is good.
And yet, almost every time, and I'm probably guilty of this myself, every time stocks go down a little, you think they're going to go down a lot. And maybe they will, maybe they won't. But just, I urge a little bit of calm and relaxation. Although I will say, chart off, objectively, as somebody who we do a lot of content, down markets are just more fun. Now, I don't like bear markets. This is not a bear market for the record. But when stocks are just going up slowly, it's boring. It's not much to talk about.
I could see the Business Insider headline tomorrow. Like, Michael Batnick wants people to lose money.
No, I don't. I'm saying the quiet part out loud.
I agree that down markets are more fun because there's more to talk about and more people pay attention. So as long as you're you don't have nerves of jelly and you're not out there doing stupid shit just because the market goes down, I think for most people down markets are not enjoyable because obviously your account is lower, but it reveals a lot about what's really going on in the markets. When it's 72 and sunny, you don't learn anything.
And where your personal risk tolerance is. You only know where your line is when you go over it. So
how many 5%, if you had to guess, how many 5% pullbacks have we experienced, or even 10, have we experienced since we started doing this show in, 2019? 20? 25?
No. I mean, whatever. It's a lot. Yeah, they happen all the time.
But we're here every time it happens, and we do the show, and we calm people down.
And it builds your character.
That's right.
So
man up. All right, woman up. All right. So now I lost my train of thought. Oh, let's talk about deflation. Obligatory. We're going to get, I think, the most important economic data point of the week on Friday. Not important to me, but important to the people that swing a lot of money around. This is PCE. The Fed pays more attention to personal consumptions and expenditures than they do to CPI. That is their preferred measure of inflation. I think the major difference is that PCE underweights the housing component relative to CPI. Are there any other really big differences between the two that are worth pointing out, or not really?
Well, what am I, an economist?
Yeah, I guess not. Okay.
Just a guy.
Just for those who are going to be watching at home on Friday, the number that people are expecting is 3.2% year-over-year growth in personal consumption and expenditures. And then, of course, there's a core PCE as well, which is stripping out some of the louder, noisier components. And that's going to be, I think that's going to determine how we go out this weekend. If we're going to have an extension of the sell-off in stocks, it'll be because of that. And the reason I feel so strongly is I think the proximate cause of this week and last week's sell-offs were what's going on in the bond market, which we're going to get to in a minute. We did get August new home sales today. New home sales fell 8.7% month over month, which is big. That was worse than expectations, and 5.8%. I don't know how to read this. Was it 5.8% a year ago that they fell, and now they fell 8.7? Or I don't like doing a negative number and then saying higher. That's weird to me, but maybe I'm just reading it wrong.
The housing market is thoroughly broken.
It's just it's frozen. 30-year fixed mortgage rates hit 7.19% last week. That's the high. This is all you need to know. Yeah. That is the highest rate for a 30-year fixed mortgage going back to July 2001. We also got S&P Case-Shiller Home Price Index for July. The Case-Shiller Home Price Index measures the 20 largest metropolitan areas, the housing market. That was actually up it's prices. So that's not transactions, that's prices. It's up 1.1% improbably year over year, and up 0.6% month over month, so July versus June.
So
is that surprising to you?
No. Bespoke, I'll get to the know why in a second. Bespoke tweeted, half of the 20 cities tracked by Case-Shiller saw home prices hit new highs in the latest release, including New York City, Miami, Detroit, Chicago, Charlotte, Boston, Atlanta. The reason why it's not surprising is because there are no homes, and there's still too many people that need to get into homes. And interest rates, I mean, they changed arithmetic, but they don't change the calculus. People need houses. I was talking to Joe Favi today, our friend Joe Favi.
Oh, I love Joe.
And one of the things that we were talking about, now this doesn't necessarily impact the stock market in the short term, but it does matter. Why haven't interest rates impacted the economy? What the hell is so funny?
Nothing.
Nothing?
No,
Oh, yeah?
No.
I like laughing. I like
laughing.
laughing.
You have 100% of my attention. Go ahead.
Why is it taking so long for higher interest rates to impact the economy? Well, it certainly has impacted the housing market in unexpected ways. You probably wouldn't think that the mortgage rate going from 3.5% up to 7.5% would be in line with all-time record prices, but it is. But the reason why it hasn't impacted the economy, like why is it taking so long? We keep saying it takes a while. The full impact has not been felt. Why? Consumers, how many people are getting a mortgage right now as a function of like the overall pie? Most people already have a mortgage at much lower interest rates. Is it 1/3 of home buyers own a house outright? 60% of mortgage holders have locked in rates at less than 5%. So the consumers aren't being really hit by mortgage rates.
I'm with you on that, and that's undisputable. But please, the median existing home sale price in August rose by 4%. What the hell is that? Like with where mortgages are, is this cash buyers? Like, I don't even understand how that's possible.
It's smaller
given
down
the
payments.
environment.
It's smaller down payments and it's help from parents. But again, number of transactions for new homes or even existing homes, it's tiny compared to the overall pie. It's on the margin. So the consumer is not being impacted there by housing prices. Now, yeah, for people that are getting a mortgage now, they're going to have less disposable
Right,
income, obviously.
It's a tiny slice of the population.
Okay, and then on the other hand, hold on, last thing. On the other hand, corporations, as we've discussed a million times, the effective interest rate that they're paying versus where current rates are, it's a mile wide. Microsoft, how much money did they borrow in 2020 and 2021 at like literally 2.5% rates? I don't know. So on Animal Spirits, we were looking at a chart from SocGen at net interest expense for corporations going lower. I'm like, how the hell is that even? I don't know what this chart is saying, but it's kind of wild. What I didn't factor in is that is net. In other words, Microsoft has, I'm making this up, $100 billion on its balance sheet.
Big borrower, right.
Yeah, but they have so much more cash on the balance sheet, so they're earning so much more in their cash than the money that they have. They borrowed at 2.5%. They've got cash that's earning 5%.
Yeah.
It's very unusual. Right. Weird times we live in.
So let's do September consumer confidence. Got this number. The index fell to 103 in September. 103 in September. It was 108 in August. The expectation was 105, so worse than expected. Consumer confidence fell 10 points to 73, which is a 5-month low.
Wait, what the hell is this showing? Hold on. Consumer expectations, consumer confidence. What is present situation? I don't get this.
Like when they do the survey, they ask people about their current situation, and then they ask people about the future. So like the present situation is a sub-index of the bigger index. This is a series from the conference board. Doesn't matter. Directionally, my take is, and we're going to talk more about the consumer in a second, but directionally, I feel as though this is like where the rubber is starting to meet the road. And I'll put a pin in that because I know there's some other stuff we want to do here. One thing that's funny is that we have a rate hike probability now for November, which is being widely debated. So 74% chance of what exactly for November?
No hike.
No hike. 25% chance that they hike by 25 basis points. Okay. I'm in the no hike camp, but don't go by me because I was in the no hike camp for a lot of this year.
Hang on. Wait, what you just said where the rubber meets the road. What do you and then you just stopped and you just pivoted.
Well, because here's why. We don't know. Well, I want to do the consumer stuff later. But I would just say, like, what are we going to judge? What is the Fed going to use to judge whether or not they should hike rates again in November, right? So here's something that's funny. It's possible that we don't even get the data because of the government shutdown by which they will need to make that judgment call. So this is Greg Valliere at AGF. September 30th is the deadline for a deal in Congress. And he says, quote, Biden administration officials have confirmed that the Bureau of Labor Statistics would not report the September jobs report on October 6th and September inflation data on October 12th. Also jeopardized would be the initial third quarter GDP data. So they won't even have the data if there's a government shutdown, apparently, because work will stop on that server. I don't even know I don't know how that mechanically works, but that would be really funny if the Fed just doesn't get the data.
They use stock prices, credit spreads.
Right.
They'll be fine.
There have been 14 debt ceiling related shutdowns in modern history. This is the part that I really wanted to get to for the listeners, the viewers. 8 of those took place during President Reagan's administration. Most of them lasted a day or two. And John's going to scroll through some of these as I'm talking. And I think
I remember that one. That was a big one.
This one, you weren't born for this. This is 1981. This is Thanksgiving. Some of these are comical. This is CBS News. They kind of give you like the reason why they happened. And, a lot of this is like, oh, this one's funny. Go to this one with Reagan sitting here. So that's Tammy Wynette. And the reason why they had a government shutdown is because the Republicans were all going to be at this barbecue for Ronald Reagan. And the Democrats had a $1,000 a plate fundraiser the same night. So they just instead of finishing, they just went away for the weekend and went to parties. And then the following Monday they signed it or something. But a lot of these, if you look at the history of these shutdowns, some of them are just so absurd. Like Reagan wanted more missiles, but the Democrats wanted more money for school lunches. And so they would have this 2 or 3 day episode where they just didn't continue to fund the government. And then eventually they did. So most of this took place in the 80s. We had a few of these episodes from 1990 to 1995. And that's under Bush and Clinton. And then nothing until 2013. But it's become, so here's my point. It's really hard to scare people who have been through this already several times. That all of a sudden they need to liquidate their portfolio because of a government shutdown.
I don't think anybody does that anymore.
No, but this is my point. It's hard to scare people with the same thing. If you look at these past episodes, 2018 with Trump, they did this thing about immigration, and Trump demanded $5.7 billion to pay for the wall across the U.S.-Mexico border. And then at the last minute, they signed the bill. So it's this is a game that we've been playing for a long time. I understand there are reasons to be bearish right now, and there are reasons to take less risk. I don't think that this is a valid one. What are your thoughts?
No. I hate the game.
Hate the game. I completely hate it. Okay. All right, you're up.
All right. Let's talk about some risks to the economy. This is fun. All right, this is from the Wall Street Journal. The U.S. economy has sailed through some rough currents this year, but now faces a convergence of hazards that threaten to create more turbulence. Among the possible changes this fall: a broader auto worker strike, a lengthy government shutdown, the resumption of student loan payments, and rising oil prices. Each on its own wouldn't do too much harm. Together, they could be more damaging, particularly when the economy is already cooling due to high interest rates.
Biden was picketing with the UAW this week, and Trump's making noises about how he would handle it, presumably with a table full of McDonald's. But it's bad. The workers' strike, I think, it's not its own problem. It's a symptom of the bigger problem, which is just this huge catch-up in employee pay, and it affects all industries. It's no different than the writer's strike in Hollywood versus the streaming platforms. We're just in this moment where there's just been this huge uptick in prices for everything from insurance to healthcare to now gasoline again. And this story is not going away. And it has not yet shown up in margins, corporate margins. All these pay hikes and all of these strikes and demands. It really hasn't had a big impact. Maybe because there's very little unionization at companies like Apple and Alphabet. That's not a challenge that they're reckoning with. And a lot of the earnings in the S&P are coming from companies like that. And maybe that's the reason why this hasn't spilled over into a bigger story with respect to S&P 500 earnings. But I feel like it's coming. What else did you have?
Does this give a leg up on Tesla compared to the other giant automakers? It's got it.
I feel like between Biden and Trump, depending on how involved they get with this and how long it drags on for, they could crash the domestic automakers. They could do a ton of damage if they instigate this to go on for longer. And that's not saying I'm taking a side or I have a strong point of view on who should get paid what. I'm just making the point that it does seem to favor the Tesla story versus the other automakers.
General Motors found strong support at like 31, 32 several times over the last, I don't know, going back to when is this? June of 2022. And it's basically on the edge
that
right
stock that stock sucks. Like that stock's been like within the same 10-point range since 2011.
All right, I want to talk about
literally does nothing.
I want to talk about leading economic indicators. So this chart shows the year-over-year change with the year-over-year change in real GDP. Now, it doesn't really track exactly, but there's a pretty big gap between the year-over-year change in blue going negative and real GDP just does not respond. The next chart, please. This breaks down what are some of the underlying components. You've got
leading economic indicator components.
So within the financial bucket, you've got leading credit index, you've got the S&P, interest rate spreads, and then you've got the non-financial components, consumer expectations, ISM, index of new orders, building permits, average weekly hours. So it's quantitative. It's not, these aren't, I know there's surveys underneath it, but it's a quantitative measure. And the upshot is this. This has been down for 17 consecutive months. Going back to the mid-90s, the only other time that we've seen anything like this was during the GFC. Now, I'm definitely not, trying to be alarmist, but,
I mean, this is wild. I mean, they're not showing us consecutive advances. They're just showing declines.
Consecutive monthly declines.
Right, but if you like overlaid this and let's say in red you saw consecutive advances, it might calm you down a little bit. I don't know. That does not look great. I got to be honest. The Wall Street Journal today did a story. This was their big story of the day. Americans finally start to feel the sting from the Fed's rate hikes. And the gist of the story is borrowers shopping for mortgages or auto loans are experiencing sticker shock. New 30-year fixed around 7%. That's up from 3% 2 years ago. That increase can mean a home buyer has to pay hundreds of dollars more a month compared with 2 years ago.
Wait, Josh, pause for a sec. So you talk about people getting less for their money. So Michael McDonough has a great chart that Ben and I spoke about in Animal Spirits today where he shows, so the average monthly mortgage for a 30-year fixed, 20% down, is $2,300 a month. Pre-pandemic, it was $1,000. So from 2019 to today, it's up 130%, $1,000 a month to $2,300. So he flipped it on his head and said, okay, what does a $2,300 down payment, what does a $2,300 monthly mortgage payment get you today versus what it would have bought you in the past? And pre-pandemic, it would have bought you, just in the beginning of the pandemic, it would have bought you a $700,000 house. Now it gets you $400,000. So your money is going a lot less than it used to. And for people that are in this situation, it's hell.
Here's Mark Zandi, chief economist at Moody's. He estimates, he says buying a home or a car right now is, quote, completely unaffordable for the typical American household because you're mixing higher borrowing costs with higher prices. He estimates the typical American household would need to use 42 weeks of income to buy a new car as of August. That's up from 33 weeks 3 years ago. The National Association of Realtors calculates the typical American family can't afford to buy a median-priced home. I don't know what the let's throw this chart up real quick, John. This is average monthly car payment during the second quarter. Focus on the red. So that's a $700. That's a $700 average monthly payment for new cars, and that's on top of everything else that's gone up in price. So I don't know what it says in the country when the typical American family, I guess typical by income, can't afford to buy a median-priced home. We have a severe imbalance here. And I don't know what the solution is. We're not just going to start like government-funded home building. And the home builders themselves, they're building, but they're not like pricing things to move. They're going to do what's best for them. They're publicly traded companies. They're focused on profitability. So they're not just you're not going to get some sort of Marshall Plan where Toll Brothers and KB Homes come out and just start erecting hundreds of thousands of houses. It's not going to happen. So this is where we are, and this is my lead in. I think that's why consumer confidence, which we put a pin in before, is basically crashing. This chart comes from Bookvar. So we talked about the consumer confidence index. This is what it looks like. This is crashy to me. So, I mean,
first of all, it's not crashing. Number one. Number two, this trend that you're talking about has been in place for a while now. I think this is just gas prices.
Fine. September consumer confidence, 103, down from a revised 108.7, 2.5 points below the expectations. It's the lowest level since May. The components were mixed, slight increase in the present situation, but more than offset by an almost 10-point month-over-month drop in the expectations component. And again, lowest since May. It's I feel like it's not done. I don't think a stock market bounce in October is gonna change the direction that we're headed in. Consumers are pissed, and with good reason. And the underlying causes of them being pissed are not all of a sudden going to evaporate. So I think this is a story that's going to be with us through the end of the year. What do you think?
So, well, two things. I'm looking forward to seeing the household debt and credit report, which comes out from the Federal Reserve Bank of New York. If you look at credit card delinquencies, mortgage delinquencies, auto, it's up a little bit, but it's really nothing with nothing. It's basically where it was pre-pandemic. So I'll be looking out for that. Number two, JP Morgan's Guide to the Market has a chart showing the household debt service ratio. Now you're talking about feelings, I'm talking about facts. The household debt service ratio, which is the debt payment as a percentage of disposable personal income, is 10% off the lows of around 8%. In Q4 07, that was 13%. So the facts are that people are much less levered and sensitive to interest rates than they were 15 years ago. They just
unless they have to buy something.
Yeah, fine. I agree. If you're in the market for home right now, it's brutal. I said it's hell, and it really is.
Yeah. All right. Got a new iPhone. Are you getting it? The iPhone 15 came
Absolutely.
out on Friday. There were pre-orders already. The analysts seem to think that this thing is selling as well or better than most phones in recent history.
Did you have to go to the store? How does this work?
I didn't. You don't have to go to the store. You can buy it on Apple.com.
Do you have a phone broker? Can you give me his number?
No, I usually go to Verizon on Sunrise Highway, and it's a corporate-owned store. It's not like a guy. And we'll probably get one because I have 4 people using iPhones, and in any given year, somebody's up for a new one. So
wait, I thought you said you did get one.
I did not get one, but we'll probably
You did not get one.
No. So there's 4 of these. There's the Plus, the Pro Max, and then the lower cost base model. JP Morgan last week said that lead times for the more expensive Pro and Pro Max models are higher than for the lower priced options. Other analysts are agreeing with that.
Question for you. When you get a new phone, so I just roll it into my phone bill, and it's nothing. It's like $15 a month extra, right? When you buy or whatever it is.
Yeah.
Are interest rates going to impact how much this costs?
I don't think so, but I wouldn't know. I've never borrowed money to buy a phone. So
Why? You just buy it outright, not to brag?
No, I'm up. So the deal that you have with your cellular service provider is that you're like up for a new phone when you're up, and you
right. I feel like you're always up.
You got it right. Well, that's my point. I have 4 iPhones going on in my house. So each line that you're paying for from Verizon, that phone has like a time where it's like, oh, you're up for a new phone.
But also, you know
we'll
what?
Just share it.
I feel like there's like 3 years between every new iPhone release, right? So it's almost
like 18 months.
Fine, but it does feel like you're always up for a new one.
I think I'm on a 13, honestly.
Ew.
I don't think... I know, gross. All right. This is Goldman Sachs. We view the extending lead times for the iPhone 15 Pro and iPhone 15 Pro Max as a positive indication of consumer demand. You wouldn't know it from the stock price. And for increasing price mix, but recognize that there is little transparency into available supply, and potential supply constraints are a risk. Goldman's target for Apple is 216. There's this thing going around where they're saying the new phone heats up. Did you hear any of this shit?
I saw some stuff.
All right. So Apple made this phone out of titanium.
All right, dude, nobody cares. You're not a scientist.
I didn't say I was a scientist. I'm making the point that this might become an issue if it like really goes around and people hold back from buying it until they hear more. So Apple made the phone out of titanium, which does not cool off. There's like a thermal situation, apparently. I'm not a scientist. And it does not cool off the phone the way older models did. And initially, people were blaming the fact that it's an Apple-designed chip. They designed a chip with TSMC, and people are saying like, "Oh, maybe
what
it's
is
the
it? What is it?
Apple
An
chip."
element?
It's an element. It's some sort of an element, Michael. You see, it's elementary. But other than that, I haven't heard anything negative about it. I haven't gotten one myself yet.
So people are going to buy the iPhone because they always do, because people always find money. I don't know how. I don't know. Are you worried about the consumer? Like, the way that I look at the consumer, maybe this is probably like a very crude way to look at it, is...
Well, as a scientist, I'm sure you can understand.
I look at Discover Financial Services.
Yeah.
And I look at Capital One. And I look at Ally. And none of them are looking too good.
American Express, on the other hand... I know. Well, that's the Apple consumer.
Yeah.
You're looking at fucking Discover Card and talking about iPhones. It's two different people.
Yeah, I know. No, I know. And Amos doesn't look great either, to be honest.
All right, let's do this. Let's do this action mode. What is this shit?
They added action mode, and my favorite way to use it was with the 3x lens.
This
Now
is so
5.
sick.
I can start recording here, and I'll punch way in. Let's say we want to get a Michael Bay shot of this statue. So as I'm walking, this looks completely shaky. This looks like this is going to be unusable. But trust me, just try to keep it in the center approximately, and action mode will do the rest.
Oh my God. This is going to save the economy. This is it.
Is that AI?
Holy cow.
How do they do that?
Holy cow. Do you know that the iPhone does more revenue than McDonald's, Netflix, Pfizer?
Nick Beats is asking, is there a mudroom mode? I don't even know what that means.
Neither, but I like it. How crazy is that?
Yeah, just in case I'm about to make like a student film for my class at NYU. No, I think that's cool, especially if you're filming like your kid playing soccer.
You know who needs that? Chris. He's got his
totally.
Instagram is an abomination. He needs that badly.
The worst thing I've ever seen. If you're filming your kid playing sports and you're running down the sideline tracking them and they score a goal, and then you could like use that action mode to take out all the shakiness and maybe like put like music behind it.
Crazy.
You might actually make a video of your kid that somebody else wants to watch, which most people are not capable of doing. All right.
Unbelievable. Let's keep it going.
Go ahead.
All right, let's talk about real yields. So yields are up. Charts on. Top is what? This top is nominal. Bottom is real. So
10-year nominal on top, 10-year real or inflation adjusted below.
All right. Where's this from? This is from Goldman. So short versus long duration pair trades tracks the path of real yields. And we're looking at, I guess this is just value versus growth, more or less. Short duration stocks have been outperforming when yields go.
I'm sorry. I'm an idiot. So the light blue is the 30-year real U.S. Treasury yield, which is now positive 2%, meaning in inflation-adjusted terms, on a 30-year Treasury, you're earning 2% above the rate of inflation.
Yeah,
and they're comparing this to a basket of stocks.
But it's actually interesting. It's short duration assets versus long duration. So think like, I don't know.
So the 30-year is the ultimate long duration asset.
Like Pepsi versus Peloton, for example.
Okay.
But what's interesting is that these have tracked pretty decently, but now it broke apart.
It's breaking down.
It broke down, and it also broke down in gold. Next chart, please. So you've probably seen this chart a million times. You're looking at gold
in red.
and inverted real yields. And
so that's the 10-year. They flipped the chart upside down.
Correct.
Okay. So these were tracking very closely until what? Spring of 2022?
So higher real yields should be hypothetically and also in reality competition for gold, right? Yeah. Gold is a yieldless nothing.
Yeah.
And gold's hanging in there. And more interestingly, I mean, it doesn't look great, but it doesn't look terrible with a really strong dollar. All the conditions are there for gold to get crushed, and it's not.
Yeah, I think gold is like a fear hedge more than it is an inflation hedge. And I expect it to hang high so long as volatility is rising and there's so much uncertainty about interest rates. And now we have this government shutdown. Like gold is the perfect asset for this moment.
Meanwhile, even though stocks have been going down, the VIX is not even at 20.
I know.
It's pretty orderly
sell-off. Wait, what does Nicola say? Like, call me at 30?
Something like that. Yeah.
Something like that. All right. What are we doing? Oh, huge losses, though, for big bond ETFs this year. I know it's relative, but the AG, so the U.S. Aggregate Bond Market ETF, which is an iShares product, it's a $92 billion ETF. It's down 12% since the Fed started raising rates. So this is a Bloomberg U.S. Bond Aggregate.
It's not down a lot this year, though.
No, but just since like the rate hiking cycle started, it's off 12%, which for like a pretty vanilla bond fund, that's a pretty notable drop from its peak.
Totally,
in recent history.
Totally,
I'm
just saying. Year to date, they've been fine. All right, so this chart is from. Chart back on, please. This is from Jason Gepford at Sentiment Trader. He said, absolute devastation of fixed income. The average U.S. bond is trading at 86 cents on the dollar. This includes treasuries, corporates, mortgages, et al. Total carnage. Chart off, please. The reason why this is why I said they're not getting killed this year, they got killed in 22 because there was no buffer, right? Going from 0 to 5 is
you had no income too.
Devastating.
Like, yeah.
So going from 4 to 5, while not great, I mean, the AG is flat year to date, even though rates are screaming higher. Now, if you have more duration, kicked right in the pants.
The 7 to 10 year U.S. Treasury bond ETF, which is IEF, has fallen 15%. The TLT, forget about it. That's the long bond. That's down 30%. We're going
to get into more of this later. Last thing on this topic before we go to dumb money. So Balchunas tweeted, people keep piling into TLT. Another $750 million this week. Amazing. Can't recall an ETF taking in so much money while being down so much and so consistently. This is rational behavior, in my opinion.
So, yeah, I agree.
Like, especially if you're not trading and you're buying. It's like, listen, I don't care if rates go higher. Fine. Yeah, I'll have some paper losses.
Well, hold on. We talk so much shit about people chasing winners.
This is great behavior.
This is great behavior. The TLT is down 30% from its high, and we're probably within one more rate hike of the end of the cycle. And no matter how much this thing is down, 2 weeks in a row, people are piling into it. And I love to see it. Is that financial advisors doing that?
I love to see it too. This is not your martingale.
Are we doing that?
This is not your martingale strategy.
No.
Right? Where you just keep doubling. No.
Treasury,
this makes sense. At some point, rates will peak. And even if they don't, I mean, well, they will. You are buffered. You're already getting 5%.
And if you're a recessionista, this is your trade. Like this is where scared money's going to go. Sorry. The dumb money, you didn't see it, I did. So I'm going to give you my reaction. I've mentioned this before. I don't do reviews. Like when people put out a book and I write about it, I write a book reaction. I don't like to review because I'm not a professional critic. No, like I react. Like I'll be like, all right, I like this. I didn't like this.
I mean, what's the difference between reaction and review? It's the same thing.
Is that semantics? I don't know.
We're not different. You're not a professional.
No, I'm not giving it all right, let me put it to you this way. I'm not giving it a grade. I just want to like say what my reaction is to these things.
There's a lot of throat clearing. What's going on here? You okay?
Dumb Money movie had some really entertaining moments. I would have made the movie a little bit differently. So I understand why they made it the way they made it. Let me back up. They put a lot of emphasis onto the regular people who were using Robinhood and buying the meme stocks and riding the wave higher. They really wanted to show you like why these people started to quote protest trade and why it was so us versus them. Mm-hmm. And I guess I didn't hate that part. And America Ferrera, who's an amazing actress, is like, she's like a nurse in a hospital dealing with COVID patients all day. And this is like her like, disgust with like how the hedge funds get bailed out and blah, blah. All right, fine. I'm fine with all that. I understand that's what you need to make the movie work.
That was a story.
Yeah. So my opinion, they spent like 50% more time on that storyline, those storylines, like 10 of those types of characters.
Okay.
And I was just like, man, you got like so much else that you could do here. This Pete Davidson was actually good in the movie. So he's like the big brother of Roaring Kitty. And I don't know if that's a real life character. This is Paul Dano as Roaring Kitty. He was
Love
great.
That guy. He's such a good actor.
He was like terrific. By the way, he's just a silent killer. You never hear his name, but if he pops up in a movie, he's amazing in it.
And you know it's going to be good.
Yeah. All right. Let's pause right here. This was my real issue. These are three of the funniest, character actors you could possibly have brought into the movie. D'Onofrio playing Steve Cohen. He's Private Pyle from Full Metal Jacket. He's been around forever, playing great characters. He played Stevie so understated. It was almost like he was whispering his lines, and I felt like it could have been a way bigger character. Offerman was wasted even more. Offerman is playing Ken Griffin from Citadel. And basically the two of these guys have to bail out Seth Rogen's character, which is, what's his name?
Plotkin.
Gabe Plotkin. Okay. Rogen is totally wasted. Take me off. Rogen is really funny. And I've never seen him play such a milquetoast. Like, he had like maybe 7 lines the whole movie.
You know, Plotkin bought the Hornets. That's how bad they stuck it to him.
Yeah. Well, listen, so it's not a critique. I would just say if I made the movie,
what would you do?
The three of those guys would be like 70 or 80% of the screen time, Roaring Kitty 20, and I would have thrown out all these other characters that are like made up composite characters of regular traders. That being said, they told the story really well. If like I took Sprinkles, she totally understood the whole story and how everything happened. And the exposition in this movie is tough.
It has to
because you're trying to describe something that's going on the internet. So you have to like show people's phone screens. They handled that really well, and that could not have been easy. And I bet you they had to cut out a whole lot of stuff and still try to make that work.
All right, so that's not a review. That's your reaction. It's just a reaction. It's not a review.
I would see
it.
But
here's the thing. Here's the thing that's tough about finance movies for people that are in financial services.
Yeah,
there almost has to be a movie for us and a movie for everybody else who needs to have it explained to them, right?
Yeah.
So it's really hard to thread the needle. And I don't generally love finance movies. Like, there's a short list: Wall Street, Boiler Room, Margin Call. Like, I didn't love The Big Short.
Oh, so I disagree with you on that. I thought The Big Short was brilliant. Some great performances in that too. Steve Carell is incredible. Like, I just thought the performances in Big Short were really good. One other thing I would say is, like, they made the bad guy Vlad from Robin Hood. He's the villain of. Did you know that? Mm-mm. Gabe Plotkin is not the villain. You feel bad for him.
Who played Vlad?
Somebody I've never seen before. I think I met Vlad once. I don't really have a good handle on like him in real life. He doesn't do that much media. But they did all the scenes with him talking to Elon and with Dave Portnoy crucifying him. So it was a really well done movie. I was just surprised they made the Robin Hood guy the bad guy, where all of a sudden the buy button disappears and everyone loses all their money. And I know that's how it actually happened. But they really made him look like a D-bag. And he was like the villain of the movie.
That was crazy.
That was
what
totally
a scene.
Crazy.
Oh my God.
But then the last thing, they're like, hedge funds from now on have to pay attention to what the dumb money is doing. Dude, every single character in that movie is like as wealthy now as they were prior to this whole episode. Like, they're all going to be fine.
I think
more.
we all understand the sentiment, but it was unfortunate what happened because it was only going to end one way. I don't know what the market cap of GameStop was. I'm sure it was bigger than a lot of companies that had no business being there. And I understand where that mentality came from. It just was only going to end one way.
Dude, but the apes are like not up. Like, let's be honest. Like, if you
I'm saying it was inevitable, of course.
And they did no Bitcoin stuff, which I thought was a good choice. Thank God. They left all that shit out, and I'm really glad they did, because that's its own movie, and there will be many movies. And they were responsible about just explaining the mechanics of the short squeeze, which I was impressed with. But if the takeaway is like that we're celebrating the worst trading any of us have ever seen, like we're making heroes out of people for doing like really reckless shit with their money. I mean, I don't know. I guess like you want to lionize the people that like drove up the short squeeze, I guess, because it's an us versus them, rich versus poor movie. So I kind of understood the choice. I think I would have made it more a comedy, and this wasn't as funny as it could have been if they used those three characters more. Just my personal take.
Good,
all right,
good non-review.
Good reaction.
Reaction. That's what I'm saying. Okay. All right. So it sort of felt like a bull market for a second.
Yeah.
Did you know that the industrials of the Dow Jones variety made a new all-time total return high in September? No, not September.
No.
July. Did you
July.
know that?
Yeah, July.
In
I
July.
did know that. It was Apple though.
You didn't know that.
No, I did know that.
Don't
but
pretend
most
you
of the
didn't know
stock, but most of the industrials did not. It's a price weighted index.
No, yeah, but the Dow is not weighted the same way as the S&P. The S&P, meanwhile, was only 2% from a new all-time high.
Yeah.
Kind of interesting. All right, chart on, please. We're going to go through some charts. So these are the total returns since the Fed started raising rates in March of 2022. The NASDAQ 100 is up 5%. The S&P is flat. The Dow is down a little. The Russell's down more. The microcaps are down a lot, down 20%.
When is this since? This is since the first rate hike?
Since the first rate hike. Now, chart off, please. You could say, we're not in a bear market. Look at those charts. You could also say, kind of amazing that the Fed took rates from 0 to 5.25.
Oh,
and
I'm
stocks
sorry.
are flat.
Sebastian Stan played Vlad from Robin Hood. He is he's like the guy in the Captain America movies.
Oh, he was
Bucky. He was
Bucky,
in Pam and Tommy.
Yeah.
All right. Thanks to
He's a Winter Soldier.
Thanks to Christopher Brown for letting us know.
I like this guy. Handsome fellow.
No, he's good. They made him the villain.
Yeah. All right, charts back on, please. So this is Urian Timmer. Is this really a bull market? If indeed a new bull market started on October 13th, 2022, it is certainly testing our patience. The 23% rally remains well below average in terms of the typical recovery slope from a bear market low. So for those of you who are listening, not watching, Urian shows all market rallies from the bottoms in the past. And the blue line, there's a blue line that's average. And we're, it's not terrible, but
nothing special.
Really nothing with nothing.
Yeah,
really
pull out the fangs, and it's way worse.
Well, we're about to. So next chart, please. I had Nick Majuli make a chart for the Russell 1000 median total return by market cap decile since the Fed started raising rates. Now, this is important. I had Nick, because he's much smarter than me, go back to March 16th and tell me what were the market cap deciles then, not now. Because if you do it now and look backwards, you get some funky results. So every decile, the median return for stocks is lower since the Fed started hiking, except for the top two, which we already knew. But when you look at it this way, it's pretty
decile by market cap.
By market cap.
So what's in
top
decile
100,
1? Is that Apple, Microsoft?
Yeah, these are the 100 biggest names in the Russell. Then the next, the 101 through 201 or whatever it is.
Everything lost money except the two largest categories of stocks.
Correct.
Since the Fed started. That's a great idea you had, and nice execution by Nick.
So not that the Fed's target was, necessarily taking the stock market, but it's happening a little bit.
Yeah, I think people are not calling this a bull market. If you pull out, the S&P 50, like nobody's calling this a bull market. And if you're in this market in individual stocks, you do not feel as though you're in a bull market.
Hell no.
You don't.
Now I would say I'm a glass half full type of person. The fact that the median stock is basically up a little bit overall since the Fed started hiking, it's kind of miraculous. All right, next chart, please. This is from Bar Chart. S&P 500 equal weight index is more than 2% below its 200-day moving average, while the S&P remains above. This has only happened 5 times in the last 30 years.
Ooh.
And the dates aren't great.
Oh, yeah.
August 98, January 2000, September 07, October 18, and March 2020. Although March 2020 was the bottom, so we'll take it.
Yeah, it's not great.
Not great.
Yeah, gun to my head. We're not done going down, but
yeah. What do you know? Next chart, please.
Gun to my head.
Yeah, next chart, please. Russell 2000 sectors. Hold on. You know what? Chart off. Josh, that's not a brave thing to say. When stocks are going lower, they're not done going lower. Yeah, who thinks stocks bottom today? Nobody.
Can I tell you why I don't think so?
Please.
Maybe it'll add some legitimacy to what I'm saying. I look at internals as a scientist, and one of the things Sean and I were doing on Halftime Report today, we were looking at the percentage of stocks that are oversold. And that's one of the things during a dip or a correction that I think is worth paying attention to.
It's nothing.
What do you mean? It's something. I'll tell you what it is.
No, I'm saying stocks aren't oversold.
Oh, yeah, fine. You're agreeing with me. My point is only 20% of S&P names are at an RSI of 30 or below.
Yeah.
I think you kind of want to see that closer to half before you could be like, all right, this is washed out. So that's I don't have a prediction or a price target. I'm just saying, like, I feel like we need to see like more of a washout, and my guess, we probably will.
Okay. You might be right. You might be wrong. One last chart from Bespoke. Russell 2000 sectors. The average stock distance from 52-week high. This is gnarly. A lot of the small stocks are just getting blown to smithereens.
Ugh. Look at
the average healthcare. The average healthcare.
What the hell is going on with Russell 2000 healthcare are like?
Dude, look at XBI.
They're like preclinical biotechs, right? They're
what is going on with XBI? Looks like absolute garbage.
Yeah,
just not great. All right, I'm gonna make the case now. Several weeks ago during the rally, I was finding it harder and harder to make the case because every stock was up, right?
Yeah.
Like it was just hard. I'm not trying to
don't have that problem anymore.
Yeah. So I've got several cases to make, and I'm going to run through them real quick. Now, news this afternoon: Target to close 9 stores across 4 states due to theft and crime.
Not a lot.
No, it's not. But we spoke about this, or you spoke about this. Like soon they're going to start shutting some of these stores. So, New York City, in Harlem, and Seattle, and San Francisco, and Portland. It's horrible. And this is definitely going to be politicized.
What the hell? And what the hell do you replace the Target with? Like in an urban center, like in a city like Seattle or New York. Like when Target goes out, it's not like Walmart slots right in. Like what do you even fill that space with?
Yeah,
it's just people sleeping on the floor.
So I don't like to buy stocks that are crashing and haven't even done anything remotely resembling a bottom. But Target is on my watch list. I will be stalking. Next chart, please. This thing is down close to 60%. It looks just horrible. But I wouldn't mind buying this a little bit higher if it starts to show some signs of life.
I mean, for what though?
What do you mean for what? It's called investing, son.
Like for a bounce though. Like you don't want to be a shareholder in Target, dude.
I have no interest in catching it for like an 8% bounce. I'll wait for a bounce and try and catch a higher low.
And share a little trading tip with you. When you're about to punch in buy TGT, at the last minute, put an AMZN instead.
Okay.
Go ahead, continue.
Next, God, that's such a buy signal. Next chart. All right, here's another one that, Josh, I know you hate. And this is a stock that I've been stopped out of, that I do not own. Dollar General. It was on the cover of Bloomberg Business Week. Hate your job, try working here. Why Dollar General might be the worst job in America.
Yeah, I bet it is.
Next one, please. JP Morgan. Dollar General's core low-end consumers already at a stress point, acting recessionary today, given 1, diminished savings, 2, inflation pressure, 3, student loans, 4, fuel prices. First half 2024 macro headwinds sequentially worsening. Cuts to sell 116 target. Next chart, please. This stock is down 60%, has not seen anything like this in its history. Again, I am going to wait for it to stop crashing, but this is another one on my buy and hold list.
If you really want to bet on this consumer recovering, which is the bottom,
that has nothing to do with it.
So what's the investment case for Dollar General?
That has nothing to do with it.
Well, tell me what it is. I'm asking you.
Just overreaction. Is it really this bad?
So it's a stock. It's not to you. It's not like I'm investing in the company.
Dude, I'm not
buying a stock that's down 60%.
I'm not. This is not a buy for 3 years and hold for 3 years type. I'm not betting on a turnaround or management fixing it. I know the company is legitimately under the pressure. However,
I'm older than you, and I have seen many retail bankruptcies, the likes of which you and your generation cannot even fathom. We had stores that
all right,
were
it's enough
part
of this.
Of the
we had
fabric
stores.
of this
Nobody
nation.
cares. We had stores.
Woolworths, Caldor. Like you don't even understand that these things existed. They were so big. They were like part of the country, and they go. When they go, they go. I'm not saying that's going to happen at Dollar General, but I'm just like, I'm making the point, like down 60% could be down 90%. Do you know there used to be Rite Aids from coast to coast? Rite Aid. Things just, they go.
No, it's a fair point. It's a fair point.
That's all I'm saying.
It's a fair point.
They don't have to bounce back.
It's a fair point. But my point is, if you look at what's going on at Dollar General, it is not, it's bad. It's bad. They're underperforming Walmart dramatically. But
Sears.
It's not.
Look at the chat. Mervyn's, JCPenney, Kmart, Radio Shack, Thrifty.
Listen.
Thanks, guys. Steinmart, Montgomery Wards.
I'm waiting for higher
low. Sucks in good times.
Okay. Waiting for higher low. Does not suck in good times. All right, but the actual thing that I did buy, and now listen, this is just I'm gambling. This is pure gambling. So we spoke earlier about bonds. Now, I legitimately think that bonds here are a gift, whether or not rates continue to go high, which they probably will.
This I'm with you on.
I think if you are an investor, you can buy. I'm not saying you need to buy the zeros, like or be a cowboy, but if you want to buy just something simple like the ag or whatever, with wherever the duration is, I don't know if it's 6.5, with starting yields at 5.5, you're not going to get destroyed. You might lose some, but if you're going to buy and hold bonds, you're going to be fine. Okay, that being said,
I like this pitch.
That being said, I'm being a cowboy, not with a lot of money. I'm just playing. I bought
TLT.
No.
Did you?
Leverage.
No.
I don't even want to get
what?
I don't even want to get the ticker.
Leveraged was that TBT?
I'm not even telling you.
What is the leveraged long bond? I forgot the ticker.
I bought TMF. It's the daily 20 Treasury 3X.
You understand that you have just set up Michael Batnick versus Bill Ackman, right? I've literally set this
I
up.
just feel like it's like we're at
Reminder to our listeners: this is not only not financial advice. This is poor advice.
This is poor advice. Now I'm using leverage. I am not going to be in this because just the reset and the decay and all that shit. This is like a week and I'm out either way.
Okay. No, listen. It's a trade. Anything can happen with a trade. I'm with you.
It is a gamble. I'm buying. Whatever. I'm having fun.
All right. Let's go out with a W for you. We have a mystery chart, and I think you're going to nail it. This is like a very important consumer discretionary company. It is not just important in the United States, but globally. Okay. Its chart looks like shit, as you can clearly see. The top pane is price, and the bottom pane is market cap. No Googling.
I think I know
No Googling. First of all, would you buy this with your own money? Would you buy this stock right now? Because you seem to love these falling knives. Would you buy this one?
Oh, no, absolutely not.
Knowing nothing.
No, of course not.
What if I tell you it's a dollar store? Would you get excited then? No, it's a company whose products you use and love. You more than me, actually.
Starbucks?
No.
Nike?
Very good. Well done. Second guess. Hit that drum roll. NKE, baby. This is year to date. Let's put up, I want to show you 5 years of this nightmare.
God.
Oh, my God. Ooh. So Nike is now round-tripping the pandemic, believe it or not.
This is filthy.
That's pretty bad.
No, I have no interest in this.
So it's cheaper than its like 5 and 10 year median valuation, but it is not a cheap stock relative to any other stock. And it's a tough situation because I feel like people gorged on sneakers during the pandemic like everything else. And they're just like slowing down a little bit.
You know what's hitting an all-time high? Lulu versus Nike.
Yeah. And then also on the footwear front, Hoka is like a hot brand on
cloud.
Yeah, like there's look, these are tiny compared to Nike. I doubt they're hurt, and Adidas is in bad shape right now. So theoretically, Nike should be kicking ass, but it's tough. Like Foot Locker blew up earlier this year. I don't think Nike's bottomed. I think the stock gets to 80 before it gets to 100. What do you think about that?
It looks really bad.
Terrible. All right, we're gonna wrap it up. Hey, everybody. Tomorrow is Wednesday, which means you get an all-new episode of Animal Spirits podcast first thing in the morning. It'll appear on YouTube later in the day. Stars Michael and Ben, personally my favorite podcast of the week. Make sure to check that out. Ben is doing a live Ask the Compound right here on YouTube. And at the end of the week, another episode of The Compound and Friends. Thanks so much for watching tonight. We appreciate you, and we'll see you soon.